In the world of real estate investing, big moves often signal bigger shifts, and a major player has just made a move that could redefine its future. Keppel REIT, a name synonymous with prime office towers, has just made its first ever acquisition of a pure-play shopping mall. This isn't just any mall, it's a massive suburban center in Sydney, Australia. So why is an office giant buying a shopping center? And what does this tell us about the future of commercial real estate? Let's break it down. Disclaimer: this video is created purely for educational purposes only. It is not financial advice and should not be considered as a recommendation to buy, sell, or hold any investment. Please conduct your own research or consult a licensed financial advisor before making investment decisions. For years, Keppel REIT has been a dominant force in the office sector. But as the world adopts to hybrid work models, relying almost entirely on office buildings has started to look like a concentrated risk. To build a more resilient portfolio, the trust needed to diversify, and it has done so by acquiring a 75% stake in the top Ryde City Shopping Centre in Sydney, Australia. This move is significant for two key reasons. First, it's a strategic pivot into the Australian suburban retail market, a sector known for its stability. Second, it's a calculated step to secure stable, long-term income streams that are less exposed to the headwinds facing the office market. So let's look at the asset itself. Top Ryde City is not just a mall. It's described as a town center hub. It's a large, freehold property located in a wealthy and growing residential area of Sydney. The average income in its primary trade area is nearly 13% higher than the Sydney metropolitan average, which means strong, consistent consumer spending. But the real story lies in its tenants. The mall boasts a very high committed occupancy rate of 96%. More importantly, a staggering 77% of its rental income comes from non-discretionary, essential retailers. Think of major anchor tenants like Kohl's, Woolworths, Aldi, Kmart, and Big W. These are stores people visit for their everyday needs regardless of the economic climate. This defensive tenant mix provides a powerful shield against economic downturns, ensuring rental income remains stable. Now let's talk about the numbers. Keppel REIT acquired its 75% interest for about 335 million Australian dollars. The deal is structured to deliver an initial property yield of 6.7%, which is quite attractive in today's market. For investors, this is expected to be immediately value-adding, with projections showing an increase in the distribution per unit, or DPU, of up to 1.34%. What's particularly noteworthy is how Keppel REIT is funding this purchase. Instead of taking on significant new debt, the trust raised a large portion of the capital through a private placement to institutional investors. This is a very prudent financial move. In fact, after the deal is completed, Keppel REIT's overall leverage is projected to slightly decrease from 41.7% down to 41.6%. This strengthens the balance sheet and keeps plenty of debt headroom for future opportunities, all while making the acquisition in a way that enhances shareholder returns. This strategic timing extends to the broader market. The Australian retail property market is showing strong fundamentals. Population growth, driven by migration, continues to fuel demand. At the same time, there's a structural shortage of new retail supply due to high construction costs, which supports rental growth for existing high-quality centers. By securing this asset now, Keppel REIT is positioning itself to benefit from potential future capital appreciation as institutional demand for such defensive assets continues to grow. Of course, entering a new asset class comes with its own set of risks. Managing a retail center is very different from managing an office tower. To mitigate this, Keppel REIT has structured the deal as a co-investment with MA Financial, a firm with a fully integrated real estate platform in Australia. This partnership allows Keppel REIT to leverage local expertise for the day-to-day operational management, minimizing the risks associated with entering a new sector. So, what does this mean for Keppel REIT's portfolio? Before this acquisition, the portfolio was heavily concentrated, with over 95% in office assets. Post-acquisition, retail will make up about 4.2% of the portfolio, and Australia's overall weighting will increase to over 20%. This isn't a radical overhaul, but a measured and strategic step towards diversification. Management has also reassured investors that the trust will remain office-focused in the long run, with a self-imposed cap on retail assets not exceeding 20% of the total portfolio. This repositions Keppel REIT relative to its peers in the Asia-Pacific region. By adding a high-yielding, defensive retail asset, the trust enhances its overall risk-adjusted return profile, making it potentially more attractive to institutional investors seeking both stability and growth. In conclusion, Keppel REIT's acquisition of Ryde City Shopping Centre is a well-executed strategic move that accomplishes several key objectives at once. It diversifies the portfolio away from a heavy reliance on the office sector, secures a stable and defensive income stream anchored by essential retailers, and is financially structured to be immediately accretive to unit holders without straining the balance sheet. By timing its entry into the resilient Australian suburban retail market and partnering with a local expert, Keppel REIT has successfully enhanced its portfolio's resilience, positioning it for sustainable, long-term growth. What are your thoughts on REITs diversifying into different asset classes? Let us know in the comments below. If you found this analysis helpful, please give this video a like, share it with others, and subscribe to our channel for more deep dives into the stories shaping our financial markets. Thanks for watching.
What are your thoughts on this?